thought I had 25, I only had 24.8, and I can't retire. Or the other situation would be, I thought I had 30, and I have 29.9. So it's very important that you look at your annual statement. If you have any questions about it, contact the retirement board. Yes.
When is the annual statement coming out?
They should be out, I would say, within hopefully the next week and a half. But check your statement. It's very important. Okay. Anyone here work part-time? Oh, why not? Okay. So if you work part-time.
Before 1970. Before 1977, so what?
Okay, if it's before 1977, no problem. Okay, it's treated just as if it's full-time. It's after 77.
Right, yeah.
So the regulations affecting part-time service didn't come in until 77. So they weren't applied retroactively.
Okay.
So they were applied prospectively. But after 77, the retirement board looks at what your FTE is. Now, it's treated the same as full-time service for purposes of qualifying for your benefits. So if you work 20 years half-time, it's still 20 years. Okay. What happens, though, it does affect the benefit formula, ultimately in terms of how they calculate your benefit. The other thing, too, is the part-time salaries. Okay, if they happen to be part of in your last 3 years, the retirement board would annualize those to full-time. So you wouldn't be getting a double hit. So here's an example of a teacher who's age 57 with 30 years of service. The first 25 were full-time. The last 5 were 50% time. So in aggregate, that teacher has worked 91.67% of what a full-time teacher has worked. And the salaries for the last 3 years were 30, 32, and 34. So the retirement board would treat those as full-time, 60, 64, and 68. Come up with an average of 64,000. So the way the retirement board would figure the benefit formula, it's an early retirement. So the benefit formula would be 25 years times 1.82% for the full-time years. And it would be 5 years times 1.82% times 50% for the half-time years. So in aggregate, that teacher would then receive 50.05% of the highest 3-year average salary. Okay. Any questions on part-time service? Yes, you have a look there.
I'm affected by it. Just trying to see that 1.82. They told me I could never reach 100% because I had 2 years of part-time.
You could never reach 100%. In other words,
even if I put
in this example here, this teacher is retiring 3 years early. Okay? They're age 57 for 30 years, so they're 3 years away from 60. So the benefit formula says you will get 1.82% for each year of full-time service. And for any year that was less than half-time, less than full-time.
25. What if you've reached 37 years?
You had what?
37 years.
Okay. Give me an example. You have 37 years.
37 years.
Okay, very simple.
I have 2 of those years of part-time.
Right, your full-time years are worth 2%.
Right.
Right? Your part-time years, say you had 1 year at 50%.
Right, and 2 at 50%.
And 2 years at 60%. So the 1 year at 50% will be worth 1%, which is half of 2%. The 60% years will be worth 1.2%. Now, I recall coming across teachers who had 40 plus years, but a lot of it was part-time. So even though they had over 37 and a half years, they still would hit the 75% mark. So I could work 50 years and at half time, and I still would not hit the 75%. Okay. But if you have 34 years full-time, 3 part-time, so it's 2% for the 34 years.
And 1%.
50% will say that 1 year,
Yeah.
60% for 2. So it's a minimal decrease in your benefit.
So you're telling me it's like 97%. Which one's up to $1,000?
Sorry?
So I'm not sure. I guess I have to be, so I should be getting 1% for each of those half years.
Right,
and
what
for
you can
full
do-
years. So I should have 72%.
When you get your annual statement,
Pardon me?
When you get your annual statement, maybe next week or two,
Right.
it will probably show you're going to have 36 years at the end, last year,
I'll have 37 now.
now or
Oh,
2009.
I'm sorry, right, it'll be 36 is when this one
Right,
comes
so
in.
what it will say is, on your annual statement, you have 36 years at, we'll say 98.7% FTE. So essentially, you will receive about 98.7%, using that example, of what the full benefit would have been had you worked full-time.
But I could reach the 75%, you're saying, if I put enough full-time years in. I
But
could still
you had,
reach it.
to get, normally, a full-time teacher would max out at 37 and a half.
Right, which would be fine, but they're saying I can never
Right.
reach it.
But it's going to be a
Okay.
minimal reduction because you had 2 or 3 years at part-time. Okay?
Thank you.
Okay, I'm going to spend probably the next 10 or 15 minutes talking about retirement payment plan options. And essentially, when you retire, you have to make a decision as to what payment plan option you want. And you have 3 choices. You take Plan N, which is a normal retirement benefit. It gives you the maximum benefit. You can name 1 or more beneficiaries, and you can change your beneficiaries at any time after you retire. The other plans, a Plan C, which is called a period certain and continuous option, that would be a reduced benefit. Okay? You can name 1 or more beneficiaries, and you can change your beneficiaries anytime you want. You can have multiple beneficiaries, and you can change it. The other plan, the last plan, is Plan D, which is called the co-participant option. And again, that's a reduced benefit. Big difference with Plan D is you can only name 1 co-participant, and you can never change it. It's for life. Now, regardless of which plan you select, it's going to be payable for your lifetime. The key thing to remember is that once you retire, you cannot change your plan. So if you retire July 1st and on July 5th, you decide you want to change your plan from Plan N to Plan C or Plan D, you can't do it. You're locked in. So this is why it's a very important decision to make. People will ask me, what's the best plan? I can tell you statistically, about 75% of retirees will take Plan N. Probably about 7% will take Plan C, and 18% will take Plan D. But when you choose the plan, you're going to choose it based on your own income needs and those of the person you want to protect. So when you take a retirement payment plan, it's almost like buying life insurance. And the more protection you want for your beneficiary, your co-participant, the more expensive it's going to be. Okay. Now, the options are generally affected by your age at retirement, the length of the period certain selected if you're taking Plan C. If you're taking Plan D, it's going to be based on your co-participant's age as well. It's also going to be based upon how much of your pension you want left to your co-participant when you die. Okay? So I'm going to show an example. Okay. This is a teacher who's age 56, 33 years full-time service, average salary of $72,000. The spouse was age 55. So this is early retirement. Teachers retiring 2 years early. So instead of getting 2% a year, it's 1.88%. So the base percentage will be 62.04%. And when that teacher retired, he or she had a balance in their retirement account, their regular account, of $240,000. So for Plan N, very straightforward. You take the average salary in the top 3 years, times 62.04%. Annual benefit is $44,688 divided by 12, and the monthly benefit is $3,722.40 per month. Again, it's payable for life. Now, what happens under Plan N, if you die, the retirement board will take 25% of each monthly payment and subtract that from the account balance. So, the retiree had $240,000 at the time of retirement, and up to the time of death, collected $400,000 in retirement checks. So again, we'll take 25% of $400,000, which is $100,000, subtract it from the $240,000, and the beneficiary gets a lump sum for $140,000. So another way of looking at it, whatever your account balance is when you retire, the break point at which the death benefit is gone is 4 times your account balance. So if you've got 35 years of teaching, I would guesstimate you probably have upwards of $300,000 in your retirement account. So if you have $300,000, there'll be a death benefit. There'll be a decreasing benefit up until the time they paid out $1.2 million, 4 times your account balance. On average, I would say it's about 15 to 18 years before the money's gone. Even though it's gone, you still get it for your lifetime. It's just the death benefit will be exhausted. Any questions on Plan N?
You know, I just wonder, are you going to do D also?
I'm sorry?
Are you going to do D like this?
I'm going to do Plan C next, then I'll Plan
Maybe,
A.
okay.
Okay.
Thank you.
Okay, as I mentioned before, this is the least chosen plan. Okay. You have 5 choices. You can take a 5, 10, 15, 20, or 25-year period certain. The reduction in the benefit is going to be based upon your age and the length of the period you selected. So if you're 55 and you're taking a 25-year period certain, that factor is going to be a lot different than someone who's 65 taking a 25-year period certain. Benefits are guaranteed for your lifetime. Even if you take a 5-year period certain, you're beyond the 5, you get that. If you die prior to the end of that term, the beneficiary collects the balance of the term. So even if your beneficiary dies, that you retire, you die, the beneficiary starts collecting, he or she dies, it's still guaranteed. The retirement system would have to complete the payments, and I'll explain that. But in this situation here, see 5-year period certain, the option factor is 99.7%. That's what's applied to the Plan N benefit. So take the 5-year period certain at age 56, using that example, you drop about $9 a month. Go from $37.20 to $37.11. You go to a 25-year period certain, the reduction is going to be much more severe. It's about a 10% reduction. So in this case, the retiree took a 20-year period certain. So the factor was 93.1%. So instead of getting the $37.20 per month that he or she would have received under Plan N, that benefit becomes $34.65 per month. Okay. Now let's say the member died. Okay, look at this. The member died after receiving benefits for 12 years. And that benefit had increased from $3,465 per month to $4,300 with cost of living increases. So now the beneficiary will step in, stop receiving that $4,300. And let's say the beneficiary now dies 5 years after. So there's been a total of 17 years paid out, 12 to the member, 5 to the beneficiary. So at the time of the member's death, the payment had risen to $4,800. Now the retirement system will have to pay out the value of the remaining 3 years of payments. That's what they call a commuted value, present value. So in this case here, even though there's 36 months left, 3 years, because it's a present value, the state will receive $4,800 times 32.04 months and receive a lump sum of $153,792.
Did you say the state or the estate?
The state.
Thank you.
Yeah. Okay, this is not, this is kind of a little bit of a risky plan to take. If you take a 25-year period, certainly you live beyond the 25 years, you still get a check, but there's nothing for your beneficiary. Or if you take a 25-year period, certainly you live 15, there's only 5 years left. So it's conceivable that, your beneficiary would stop receiving checks. So that's the risk you would take with that plan. I would probably take this plan under two conditions. I go to the doctor and he says, Bill, you got 6 months. Okay? And I'm single, but I have 2 adult children. So I'm signing up to a 25-year period, sir. So I'll be, I'll kick the bucket in 6 months, but my kids will get 24 and a half years worth of checks for $3,365. I mean, it's an enormous amount of money. Or I might take it if I was single and I had a teenage child, and what I wanted to do is make sure that if something happened to me, that child would be able to finish college. So I might take a 10 or 15-year period, certainly. Okay, it wouldn't cost much. But if I died, at least I would know that that child would be getting that benefit stream. So I've only had one client in all the years I've been doing my consulting take this plan. And that was somewhat of an unusual circumstance as well. Okay, any questions? Okay, Plan D. Okay, as I mentioned, Plan D, you can only name one person as a co-participant. And you notice it's referred to as a co-participant, not a beneficiary. But only one person. And you can never, as I say, you never can change it. You can elect to have your co-participant receive either 1/3, 1/2, 2/3, 3/4, or the whole amount of your pension benefit. Your benefit's going to be reduced based upon your age and the age of your co-participant, as well as the fractional amount you selected. So the bigger the amount you want left to your co-participant, the more expensive it will be. So in this situation, the member was age 56 and the co-participant was 55. So if we go with the whole amount, the option factor is 87.2%. So it's costing 13% to take Plan D for the whole amount. If you go down with a 1/3 option, reduction's fairly minimal. It's 95.6%. So dropping about 4%. Now, the fraction you've selected applies to what will be carried over to your co-participant. So if you take 100% option and you die, your co-participant gets 100% of your benefit. So in this situation here, the member selected a 3/4 option. And you can see the benefit here under the 3/4 option is $33.57.60 per month. So in this case here, if the member died, the co-participant would then get 3/4 of that money for his or her lifetime. So whatever the benefit happens to be at the time of death, let's say the benefit had gone up to $4,000, that would cost a living increases, the co-participant gets 3/4 of the $4,000.
And what would N get?
I'm sorry?
What would N get? Under those same circumstances, what would Plan N get? Person that chose Plan N.
Plan N would be a lump sum.
Is the lump sum.
Right. So, remember I mentioned the way Plan N operates here. What's unique about this plan, though, if you take Plan D and your co-participant dies, or you get divorced, will pop back up to the Plan N benefit. Now, both of you die, okay, before the money is used up. We go back to that Plan N formula. So the member had $240,000 in the account at the time of retirement. and the total benefits paid to the member and the co-participant was $600,000. Take a quarter of the $600,000, which is $150,000, and it's still a lump sum of $90,000.
And that would go to the beneficiary.
Well, it would go, if the co-participant dies first, okay, benefit pops back up, you then can name a beneficiary, all right? So in that case here, it would go to your beneficiary. If you die and the co-participant is collecting, he or she cannot name a beneficiary, but it would go to his or her estate. The estate of the retirement board would not get the money. It would go to either beneficiary or co-participant's estate.
My husband and I are both teachers, so I was thinking.
Doesn't make any difference.
Well, I mean, because we could do back and forth, but our kids would be protected. Maybe
Well,
obviously we would leave the money for the kids.
If you're both teachers,
Yes.
it doesn't make any difference. Because this is what you're choosing at retirement. Most of the time, this is a generalization. I generally don't find too many people who are both teachers, who both are career teachers, taking Plan D. Because essentially, if your pension on your own is going to be adequate or better, there's no sense taking an optional payment plan. So when you're taking an optional payment plan, you're paying a premium to do that. Now, if there were two teachers, give an example. One is an administrator, makes $140,000 a year, put in 35 years of service, you get 70%. Say average salary is $150,000. You're going to get $105,000 a year on your Plan A. The other teacher only taught 10 years and had an average salary of $80,000, and they're going to get $8,000 a year. Well, it's obvious that the teacher getting $8,000 a year can't live on that. So the teacher who's getting $105,000 would probably take Plan D to protect the spouse. And the teacher who's getting $8,000 a year would take Plan A, right? Because there would be no sense in that teacher trying to, the teacher getting $105,000 doesn't need anything. So each situation is a little bit different, and it's a good segue here, actually, because, as I mentioned, everybody's different. So in this case, there's 5 different cases here. But, you can see here, the first case, single teacher, no dependents, just nieces and nephews, no need to leave an estate. So, which plan do you think a teacher would choose? What do you guess? Yeah, exactly. Here's, I think I gave the answer away already on this one. Single parent, age 56, 15-year-old in high school. Teacher's not in good health, has little in savings, minimal life insurance. What plan? C. I'd go with probably a C for, I'd probably go for at least 10 years, maybe stretch it go to 15. Case number 3, you have a professional couple, both have large pensions, lots of money, lots of cash. They could live on their own, they don't need each other's pension. What do you think they should take? I'd go with that. You don't need it. It's like buying insurance and that you don't need. So the person, if you have more than, basically you're self-insured. So if someone comes to me and they have a home in Wilton that's worth, $900,000 or $1 million, it's all paid for. They have $500,000 in TSAs, a couple $100,000 in savings and stuff. They're self-insured. They don't really need to take payment plan out. There are some people out there who will encourage you, in some cases, to take Plan N and go out and buy a life insurance policy instead of taking Plan D. Okay. In my opinion, you can't beat the option factors that the retirement board uses to reduce your benefit. Okay? You're probably not going to be able to get a better deal trying to get life insurance. So here's another one. Married administrator, spouse has a small pension and Social Security. Administrator has a $1 million life insurance policy, $500,000 in the TSA, home $600,000 worth of equity. I'd go with them. They don't need, there's no sense getting D because they have so much in assets and equity. And finally, the last one. Married administrator has a spouse, small Social Security benefit. Administrator has $100,000 in life insurance, owes $150,000 on the mortgage, has $50,000 in savings, has a TRV balance of $300,000, and is eligible for a TRV pension of $75,000 per year under Plan N. What do you think might be a viable plan there? I would probably go with D. It doesn't have to be the 100% option. But in this situation here, I don't think the spouse could get by for life with a Social Security benefit of, say, $1,000 a month, $100,000 in life insurance, $150,000 mortgage. This is where that person probably needs some form of protection. That's why I wanted to illustrate that everybody's situation is different. Even though 75% of people take Plan N. They're all different. Okay, how many of you began teaching before 1989? Probably most of you. Okay. If you began to apply to 1989, you were contributing, in the old days, you were contributing 5% every time, and 1% as well. They went into a supplemental. So starting in 89, they changed that. So the 1% you've been putting in since 1989 now goes into a health fund. And that's what's used to fund the health insurance benefits, that subsidy we were talking about. Actually, that amount has gone up to 1.25. So if you have 1% contributions prior to 89, they belong to you, right? And they continue to earn interest each year. There's no new money going in. In addition, you can also put in voluntary contributions. So right now, you pay 6% towards retirement, 1.25 for health. You can also make voluntary contributions. Over and above that, it goes into a voluntary account. I'm going to mention it. I wouldn't recommend doing it. Up until last year, it was a pretty good deal because they used the credited interest rate to evaluate the contributions, how much a balance would be, which was pretty good because it was running, some years it was running 13, 14%. Last year they switched to a market value. So people who have voluntary contributions, when they get their statement next week or so, they're actually going to have a minus 0.1% loss. So especially in this market where things have tanked, I wouldn't put a nickel into the voluntary account prior to retirement. Okay. Now, when you retire, you have a number of options you can do. The first option is you can leave it with the retirement board, and they'll give you an extra, what they call an annuity, extra annuity. So that annuity is going to be based on the amount you have in your account, your age, and whatever option you selected, whether you take Plan N, C, or D. The second choice is to take a lump sum, have it paid. When you take a lump sum, you have two choices. It can be paid directly to you, or you can roll over the taxable piece. The third choice is you can use the 1% account, the voluntary account, to buy your service. So if you have 2 years of time to buy in, you could use a voluntary account or your 1% account. You can use your voluntary account to buy service anytime. But the 1% account, you You can only use that by service at retirement. You can't do it pre-retirement. So here's, this is what the balance looks like. The, let's see here, for 1% account, balance of 20,000, voluntary account 27,000. At age 56, the annuity rate, and these rates have actually changed since I did this slide, was $8.18 per month per thousand. So in this case, the 20,000 would generate 163 a month, 163.60, and the 27,000 would generate 220.86. But if you took plan C or D, it would be reduced based on that option factor. Right now, I can tell you the annuity rate, if they change, for age 60 is $8.12 per month per thousand. So, which is a great return. So, for on a $100,000 investment, you get $812 a month. So you'd be getting $9,700 a year fixed, and guaranteed for life. Never goes up, never goes down. What you can do is you can put money into the voluntary account when you retire. This would be my recommendation. You're going to do that. You can use pre-tax funds, right? Unlimited. So if you have tax sheltered annuities, so you want to put $100,000 into that voluntary account, you can have it transferred in. You can only do this at retirement. Put it into the voluntary account and then collect an annuity. So the only downside is once you put it in to the voluntary account, it's locked in. You can't come back a year later and say, I'd really like my money back. So it's locked in. So you have to consider that. Okay, I wouldn't recommend anyone put your entire life savings into the voluntary account. But it provides a really great return, in my opinion. Yes?
Could you take that lump sum out and put it in, I don't know where, but save it for insurance? And so therefore it wouldn't be taxed, or there's no way around that?
If you take it out as a lump sum, there's two things that will happen. If you take it out directly, you're going to have a major tax liability.
Because it'll be on the year of tax.
Well, what happens is, you see here, it says after tax, 4,000, interest 16,000, total 20
Yeah.
on that 1% account.
Yeah, right.
So if you took that out, that 1% account out, the only thing that's not taxable is the 4,000. You've already paid tax on that. The 16 is subject to federal tax immediately. Plus, you're going to get hit with state tax and possibly a penalty.
So you can't just take it and move it into
Well,
an
what you can
account.
do with it, conversely, you could take that, say you wanted to take that 1%, the 20 grand, you could roll it over, okay, into an IRA or a TSA and defer your taxes. So if you decided on the rollover option, the retirement board would then send you a check for $4,000, which belongs to you. You've already paid taxes on it. And the $16,000 would go into an IRA or a TSA.
And could you draw from that for your insurance? Pay for your
Well, you can
insurance?
draw for wherever you put it, okay? You say you put it in with Fidelity or Vanguard or whatever, certainly you can draw down on it.
And you pay taxes then?
As you take it out, it's taxable.
So at least it would be
In
taxed
fact,
at that current.
at age 70 and a half, they have what they call a minimum distribution rule, and you have to stop drawing down on your TSAs and IRAs. Okay, any questions on this?
Annuity, is that something that's run by the TRB, or is that, I'm just trying to figure out how safe it is. Could it go bust?
Well, if you annuitize it
Yeah,
with the retirement board, guaranteed.
because Fidelity is not
Fidelity,
protected.
I mean, yeah, Fidelity, you could, say you had 20 grand, and you took it out, and you put the 16 in Fidelity, the Fidelity IRA, and then you took the 4,000 and you put it into a Fidelity non-IRA, all right, and they're both mutual funds, we'll say, and the market drops, your 20 grand drops.
Right, but the annuity is, if you leave it in, I just want to make sure it's run by the TRB.
Right, if you leave it in,
guarantee
okay,
is a year.
you put in, we'll say you put $100,000 into the voluntary account with TRB. You get, and you were age 60, rate is $8.12 per month per benefit. So you collect the $8.12, absolutely guaranteed for life, no matter what happens.
Guaranteed by whom?
Guaranteed by the tax system. And if you die, whatever money is left over goes to your beneficiary. So if you take Plan N and you put 100,000 in, using that formula, the 1/4 formula, basically $203 a month is coming out of your 100,000 for death benefit. So factoring in everything, to me, it's a great deal. No risk, guaranteed. Yes.
I have another question. Down here it says note, if chosen, which is optional, I can't quite read, optimal payment plan, C or D, you're going to be reduced.
Right.
Why would that happen when one has nothing to do with the other?
Oh, they do, because it's part of the plan you've selected. So whatever happens, whatever plan you choose, that annuity follows.
Well, I have 1% or whatever here,
Right.
and I have $34,000.
Okay, let's use this example here. And using that factor, all right, if I take Plan N, the 20
I
grand.
say take Plan D, I don't know, it
Right,
says
what-
C or D.
right, but I want to show you first, we have to start out with Plan N.
Okay.
So if you take Plan N, you get $163.60 a month. Okay? That's the maximum you can get.
That's per monthly. Is this just to do with option ones? Doesn't it, if I took the whole amount out, I wouldn't be affected by that?
Well, if you're taking the amount out, you're not annuitizing it.
Oh, okay, okay.
But if you took Plan D, instead of getting $163 a month, that benefit might be reduced by 10%, okay, depending on the option factor.
Okay.
Yes.
If I'm buying back years out of that, and there's money left, and then that money that's left
Good
go
question.
into an
Okay.
annuity?
Let's use the 1% account. Right. The first thing they do, let's say you get a bill for $15,000 and you have 20 grand in your account. They're going to take the 4 grand first, the after tax. Now we need 11. So they'll take the 11 out of the interest. All right. It's $5,000 left, which is interest. You would then have to take it out of the lump sum. Okay, to annuitize it. You could then do a rollover of the interest into a TSA. But once you decide you want to use those accounts to buy service, then there's no other option except for you to get a lump sum. But they do give you the choice whether it's paid directly to you or a rollover. Okay? Okay, I think that pretty much covers it. Okay, let's see, buying service. Yeah, up until 2004, you had to wait until retirement in order to buy your service. So in 2004, they changed the law, and you can buy your service at any time. Like I say, I think there's about 13 or 14 different types of service. They keep adding on to the list, like Peace Corps and so forth, and Vista. They use what they call an actuarial cost method. Okay. Again, I mentioned what you can do is you can use a tax sheltered annuity or an IRA or any other pre-tax vehicle to buy in that time. And if you have a voluntary account, you can use that as well. If you have time to buy in, and this really depends on the marketplace, I normally would tell people use your TSAs, IRAs to buy in time. Use pre-tax money. But the problem right now is the market is going so bad that if you pull it out, transfer it, you're kind of like taking the loss. Or you might just say, well, I'm going to ride it out. But my general recommendation would be, if you have time to buy as much as you can. And the sooner you buy it, generally the cheaper it is. That will vary from case to case. But again, you can only use the 1% account every time. And if you do, whatever is left over, pay the lump sum. Okay. And I'll show you a couple of examples here. So the first example was a teacher's age 56 for 33 years and wants to buy in 2 years of out-of-state service. So in this situation, the cost, if it was purchased in July of 2006, it would have been $28,727. But the following year, remember, waits one more year, another age 57 with 34 years, and the cost actually dropped. Right? That's not the norm, but there are deviations because it's an actuarial cost method. This example 2 is more likely the scenario where the teacher's age 54 with 25 years, buying in 5 years of out-of-state service. Purchase cost in July of 2006 would be $33,272, and they wait one more year, it goes to $36,119. The typical increase, in my opinion, is usually about somewhere between 8 to 10% would be the norm. Now, what you can do is you can go onto the TRV website and they have a calculator, and you can run the what-if scenarios. The general rule of thumb is that the cost of buying the service is usually about 5 times the amount of the annual increase you will derive from buying that service. So let's say you're buying in 5 years of service. So you have 30 years, and you're buying in 5 years of service. Well, the extra 5 years are going to bring you from, we'll say, 60% to 70%. So it's a 10% increase, and your salary's running $80,000. That's going to bring you, your average salary is $80,000. That's going to generate another $8,000 a year. Your cost would probably be about 5 times that. But the best thing to do is go on the TRV website, and you can run your own numbers. Okay? Now, the other thing I want to tell you, that method does not apply to someone who taught in Connecticut previously, pull the money out. So let's say you taught from 1972 to 1974 in Connecticut, took your money out. Right? You don't use that method. What they actually do is they look at how much you withdrew, when you withdrew it, and then add interest to the date you paid it back. Right? So it's just as if the money had been in your account during that period of time. I'm going to go very quickly and briefly over this. I know it's getting a little bit late. But this question always keeps coming up about deferring benefits. So here's an example of a teacher who's age 55 or 30 years. Could walk out the door, collect right then and there, 51% as an early retirement, and get $30,600 a year. But that teacher decides they want to wait to 60 and avoid the quote penalty. So
May I have your attention, please, extended learning program instructors, tutors, and students. We now have 4 buses outside, and we've got vehicles for you to ride home in. Cars, trains, trucks, RVs, helicopters. So come on down and pick your ride. But our session is ended today, so gather your things together and come walking, talking, no running, no shouting, no jumping, no leaping, no, you know the routine. Come on then, time to go.
it's a tough act to follow. Okay, so this teacher decides to wait until 60, and in that case, it's a normal retirement. Get 60%, get $36,000 a year. But if you look at what that teacher would have collected from 55 to 60, they would have collected $30,600 for 5 years, which is $153,000, and they would only gain $6,000 a year. Okay, typically. Now, you have to remember that 30,000. Well, actually, they're going to gain $5,400 a year. But you have to remember that teacher had retired at 55. They would have collected cost of living increases on that benefit. So I haven't even factored that in. But in this example, it would take 28 years to break even. I know some of you might have 34.8 or whatever it might be, and say, well, I want to round it off. It's not worth it. Right? It's not worth coming back to school for 2 months. Or let's say that your birthday, you're going to be 60 in July or August, and you want to wait until September, not working. Because retirement board counts every single month, right, full month, towards your retirement credit. And they also factor in every single month how close you are to normal retirement. So if you're 59 years and 10 months when you retire, and it's early retirement, you're only 2 months early. Right? The reduction is minimal. Right? So forget about your birth date and forget about getting. I've had teachers actually with 34.9 go back for 1 month to get to 35. And then if you factor in, well, how much would you have collected for July, August, and September to gain $12 a month? That's what it boils down to. So, collect, basically, the bottom line is collect as soon as you can. Right? I'll just mention this real briefly, but sometimes people will take what they call a leave of absence. The only time I would recommend a leave of absence would be for some critical piece. It probably won't apply to anybody in this room right now because I think you're going to go July 1st. But sometimes people will take a leave of absence just to get another year of credit. And of course, they have to pay in to leave. They've given up a year's worth of checks. It's not worth it. But I would take it, a leave of absence. Let's say I had 24.9 and I needed to get to the 25th in order to collect. I'd take a leave of absence. Or I quit at age 47 with 14 years. I'm not coming back. We'll take a leave of absence for a year, pay in and get the 15th year. But for the most part, I wouldn't recommend doing that. Any questions on this? All right, that illustrates it. Okay, taxes. Before 1991, the contributions you made to the retirement system were on an after-tax basis. So when you look at your annual statement, you can see that it says regular contributions, after-tax, 1% contributions, and so forth. Then it will show pre-tax contributions. It will also show interest. So when you retire, the IRS allows you to get back the money you put in on an after-tax basis. But they spread it out over your life expectancy. So in this example that I have, the teacher was age 56 when he or she retired and had put in $36,000 after-tax contributions. Well, at age 56, the IRS says you can recover that over 310 months. So in this case here, take the $36,000 divided by 310, and that retiree gets $116 a month tax-free for the next 310 months. Then after that, it becomes fully taxable. But for most of you, you're probably going to be 97% of your benefit will probably be taxable. The good thing is the retirement board, when you get your tax statement when you retire, after, the year after you retire, your 1099-R, they will figure that out. Okay? But most of it's going to be taxable. Okay. Social Security. Right, there's two different provisions I want to talk about. The first one is if you're claiming Social Security based on your spouse's work history. There's a federal provision of the law called the government pension offset, and it essentially affects any person who's collecting a governmental pension not covered by Social Security, which in this case would be the Connecticut teachers. But there is an exemption. If you qualified for your TRB pension prior to December 1, 1982, you're exempt. Okay? But when I say you qualified, that means you could have walked in the retirement board in December of 82 and actually retired. Right? So that means back then you had 25 years of service, or you were age 55 with 20 years, or you were age 60 with 10 years. And I don't think there's anyone in this room who comes close to that. Okay. So what happens in this situation, if you apply for Social Security benefits, based on your spouse's work history. Let's say no, you're a teacher, not covered by Social Security. They'll take your TRD pension, they take 2/3 of that pension amount and apply it against your spousal Social Security benefit. So let's say your spousal benefit would have been $600 a month, and your TRD pension was $2,400 a month. You take 2/3 of the $2,400, which is $1,600, and which is greater than the $600 claiming for Social Security. It wipes it out. Okay, so any questions on pension offset? Even though you're not eligible for Social Security benefits, all right, because of the offset, you still qualify for Medicare based on your spouse's work history. Okay. Now, if you are divorced, okay, you were married for 10 years, okay, if you haven't been married, you can still qualify for Medicare at 65. Okay? Yes?
If you still had all those quarters and you're a teacher, but you also have 40 quarters Social Security, you are entitled to a certain amount
Yep.
of Social
Next
Security.
slide. Okay, that's a different one. All right, so now we're going to talk about claiming Social Security based on your own. You have your own 40 quarters. Okay. So it's kind of the same rule, except there's an exemption if you qualified for your TRB pension prior to January 1 of 86. Same rules that I mentioned before in terms of age and service. You're also exempt if you had 30 or more years of substantial Social Security earnings. Right, so, Social Security does have a table which will show you what is considered substantial each year. What I do for most of my clients who have Social Security, I go onto the Social Security website and I enter their earnings history year by year, and that will actually calculate the Social Security benefit. So you can go on the Social Security website and use what they call the WEP calculator, and you put in, your age you want to collect Social Security. We'll say 62. Put in your date of birth. You put in your earnings history. You put in your TRB pension, and it will calculate it. Rule of thumb: you probably, if you had minimal Social Security earnings, just had your 40 quarters and you worked a lot of summers and stuff, you probably get about 40% of what it shows on your Social Security statement. So if it says you're going to get $150 a month, right, that doesn't factor in the windfall elimination provision. So if it's 150, you probably get about 40% of that, maybe about 60. So it's based upon a formula, but just to give you an idea, I haven't updated this slide in a while. For 2003, substantial earnings were $16,125. The simplest thing is just go on to the Social Security website. Okay, cost of living. Okay, if you retired, most teachers retire July 1st, I would say. 90% of all retirees are July 1. But if your retirement date is anywhere between May 1st to October 1st, your anniversary date for cost of living increases is July 1. So if you retire July 1st of 2009, then July of 2010, you'll get your first cost of living increase. It's predicated on the Social Security COLA. It's also a function of how well the retirement fund does preceding year. Now, I think for January of 2009, Social Security is scheduled to pay 5.8%. Now, that's nice, but unless the retirement fund earns 8.5% on June 30th of 2008, all bets are off. Okay? So in that case, because I know, I'm quite sure the retirement fund didn't earn 8.5% last year, the minimum will be 1.5%. Now, had they earned 8.5%, then the retirement system would have paid that Social Security COLA of 5.8. But over the period of time since this new COLA went into effect, which is 14 years ago, it's averaged about 2.3. So in this case here, I know in this coming January, the COLA will be 1.5% because of the fact that the retirement system didn't earn at 8.5% on the fund balance.
Guaranteed, I'm assuming that's because of the market value, that the retirement board didn't make the money because, you know, what's going on in the economy today. Can our retirement ever be touched? I know it was a promise, that it's supposedly not. I mean, I don't mean the cost of living, obviously that can be.
Yeah, this is.
But I mean our bulk of our money that.
Well, you could, I mean, conceivably, let's say Social Security, I know there was a year or two where Social Security actually came in at 1.3. All right. Normally, you would get 1.5, but because Social Security COLA was only 1.3, that's what the retirees got.
Okay, that's the cost of living. And I understand how that could vary because they're using our money to make money.
Now, I mean, it could go as high as 6%. All
Which is
right.
great. What I'm speaking of is kind of ring a bell, that what about the money that, you know, going back to our basic retirement fund, you know, our $3,000 or $6,000 per month, the basic amount of money that is our retirement.
Yeah, I mean, that's guaranteed. Anything that,
That's guaranteed.
Once you get into pay status, whatever you are getting, you have a contractual right for.
Okay, so that's not going to be, it can't all of a sudden be
Right,
affected by the
they can't
economy.
decrease the benefit, so
Somebody
you
can
retire
say-
and your retirement benefit is $4,000 a month on July 1st of
say,
2009.
yeah, right.
Next year, you get a 2% COLA in 2010. Now you got $80 more, your benefit is $4,080. Guaranteed, can't go down.
Right, in other words, that,
Right.
whatever the market value is
Right.
and that kind of thing won't affect.
But
the money
let's say that the following year, the cost of living increase is only 1%. Then you get 1% based on the 4,000.
Right, right. I mean, I understand the cost of living.
Yeah.
I just want to make sure that my basic retirement's not being,
The only thing is, too, I'll mention is that the annuities, the 1% involuntary annuities, do not get a cost of living increase, just your base benefit. Okay. Okay, health insurance. Okay, basically, the first part is for teachers not eligible for Medicare Part A, the hospital insurance. Your last employing Board of Ed has to offer you health insurance to you and your spouse, as long as you do not have Medicare Part A. Okay? And they have to offer you the same coverage that's offered to active teachers, so they can't carve out a plan for retirees that would be substandard, so to speak. Okay? So you have to get the same coverage, and that includes dental, prescription drugs, so be it. You can enroll at any time, so you don't necessarily have to enroll when you retire. Right? There may be a situation where you have a spouse who's working in another school district, working for the state, working for some company, and you can get the health insurance at a much better cost. You go that route. But when that coverage dries up, you can always go back, as long as you're not getting Medicare. As I mentioned, the state kicks in a subsidy of $110 for the retiree, and also $110 for the spouse. Right? So it also applies to a surviving spouse. So even if you die and you have a spouse, that's a surviving spouse, can still get his or her coverage through the last employing Board of Education. Okay. And that subsidy has to be applied first towards your costs. Right? Some towns have a contractual provisions where they might make a payment. They may pay 20%, you have to pay 80%. Unless the contract is written contrary, the subsidy has to go towards your costs first. Okay? Not too many districts that do this anymore. TRV also offers a Medigap plan. All right, once you have Medicare Part A and B, it's a great plan. They offer basically 3 plans. The basic plan, which runs $99 a month, and that's hospital, medical, major med, prescription drug. And let's say $99 a month. Can't beat that. That's for January 1st of 2009. If you want dental added onto it, it's $144 a month. And if you want the whole package, which includes dental, vision, and hearing. It's $149 a month per person.
Over and above the 99?
No, that's the total one. So it's 99 basic, 144 adding the dental onto it, and 149 for the complete package. So in addition to that, you pay your Medicare Part B, which is running about $97 a month. So if you took the best plan, you pay $149, which would be deducted from your TRV check, and $97, which would be come out of your Social Security benefit. Okay. Any questions on health insurance? Does anybody want me to talk about disability benefits, or?
I mean, disability benefits for the system? Disability benefits as a school teacher?
Yeah. If most of you in this room have 30-plus years of service, even if it's an early retirement, you'll be beat out of disability benefit. It's just important to know that the Retirement Board does offer a disability allowance if you become disabled. The thing is, it maxes out. When you have 25 or more years of service, it maxes out at 50%. So it would really depend on the circumstances. If someone became disabled, now if I had a teacher who was 55 with 25 years of service, if they took an early retirement, they would get 35%. Right? If they took disability, they would get 50%. So, if you want me to go through this, I'll let you know. Consensus? Okay. This section here really talks about pre-retirement death benefits while you're actively teaching. Once you retire, okay, the death benefits are going to be controlled by the plan you selected, whether you take Plan N, Plan C, Plan D. But under this scenario, let's say you decide not to retire this year, and you die. Okay, you're dying before you actually retire. If you die before retirement and you have no statutory survivors, so you don't have a spouse, you don't have any minor children, okay, or dependent parents, what would happen in that case is the balance of your account, okay, would be paid in a lump sum to your beneficiary. And it would also be a lump sum death payment for burial expenses, okay, and that ranges from $1,000 up to $2,000. So if you had $240,000 in the account, you died, you had no survivors, we'll say the $2,000 would come out of the $240 for the lump sum death benefit, $238 would go to your beneficiary. Okay? Now, if you die before retirement and you have statutory survivors, say a spouse or minor children, if you have 12 or less years of service, your spouse will get $300 a month. And an additional $25 a month for each year of service above the 12 years. So the maximum spousal benefit is $600 a month. And that would be paid to the spouse provided he or she does not remarry prior to age 60. If you have minor children, they would get $300 a month until age 18, and the maximum family benefit is $1,500. Again, there's a lump sum death payment of either up to from $1,000 up to $2,000. Now, this is the big one here. This is if you die before retirement and you're eligible for retirement. Now, if you meet the age of service requirement, so let's say you were 55 with 20 years, you had 25 years, you were 60 with 10, any way you could retire immediately, your spouse can elect any one of three benefits. But to have that option, he or she has to be named your primary beneficiary. So, in the example we had, sample computation, member had $240,000 in the account. So the spouse was named primary beneficiary. So door number one is take the $240,000. Door number 2 is to take the statutory survivor benefits, which would be 600. And door number 3 would be to take the benefit that was equal to Plan D 100%, and that would be $3,245 a month. That's just as if you had retired at the time of your death and selected Plan D 100%. So that one's a no-brainer. But the important thing is your spouse has to be named primary beneficiary. You have those choices. So if you forgot to change your beneficiary and then your cousin listed, the only choice your spouse would have would be, who actually wouldn't have a choice, would get the $600 a month. So, yes?
My beneficiaries, my husband and my 3 kids are under them. But I
Sorry?
mean, I have like 4 people, my husband and my 3 children are under it.
Okay.
But he would be primary because he's first, right?
Well, if you say, for example, you have your husband as your primary beneficiary and your children as contingent,
I mean, I'm assuming it's because of something happened to both of us. Yeah, I mean, we would
Yeah.
go down.
but I mean, if you name your spouse as primary beneficiary and your kids as contingent, then your spouse would get these 3 choices. Now, if you named all 4 of them as co-beneficiaries, and they're all, I assume they're all over 18, your spouse could conceivably get that benefit, but your 3 children would have to waive their rights to benefits. It's just not something you want to get into.
Yeah, I'd have to look, I mean, I think when I filled it out, I think I put the primary and I could put them
Yeah, when you do the
down.
beneficiary thing, it will show you primary, contingent.
I thought when I read something, it just had them all 4. It didn't, I saw them, in,
Yeah. Now, once you retire,
check that out.
once you retire, you're going to do your retirement application. You're going to put in your plan and how you want your beneficiaries.
Right, if I died right now.
Yeah. Well, I would do is check your annual statement when you get it, hopefully within the next week or 2 weeks. And you can download the form off the TRB website and send it in if you want to have your husband as primary and your kids as contingent. But if you have it listed as all primary, that could create a problem with dying for you.
Right.
Okay.
Not that I plan, just not that I plan on dying. Right, it's not something we really want, but, you know, we just would need to see.
We're almost
I think
there.
this would be fine.
Actually, we'll probably bring 2 more slides. This is the important one. Well, it's not the important one. Okay, this is the on post-retirement employment. So if you retire and you want to come back into teaching, there's a restriction on how much you can make as a retired teacher, and that's on a school year basis. And essentially, that limitation applies to any position which is eligible for membership in the teacher's retirement system. So typically, that would be any certified position, including principal, superintendent, assistant superintendent. It also apply if you took a job at any of the state community colleges, state colleges, let's say UConn, State Department of Ed. If it's a job that's eligible for TRB coverage, then you're limited to earning 45% of the maximum salary for that position during that school year. So let's say the district, the top salary is $80,000 in the district you're going to be working in, then you could earn 45% of that $80,000, which would be $36,000. Now, if it's a subject shortage area, okay, then essentially that for that first year, you can collect your full pension and your full salary. There's no reduction. Technically, they give you a second year, so it gets a little bit more cumbersome, so to speak. First year, it's like I say, it's free ride. Second year, the retirement board will ask the school district to show that they're making a good faith effort to fill that position. So they have to send in, showing that they can interview candidates, they advertise the position. If you go out of state, there's no restriction on your employment. And if you go to a private school, say any of the private colleges, again, there's no restriction. And you can see here, this is the list of subject shortage areas for the 2008-2009 school year. Okay, we'll make this the last one. So, thing is, if you retire July 1st, your retirement application has to be filed with the retirement board on or before June 30th. Okay, if you miss that deadline, okay, you file in July, then your retirement's going to be effective the following month, August 1st. So in effect, you've lost a month's check. It's not retroactive. The only exception would be if you become disabled and you had for some reason could not file your application, the board could consider going retroactive for, I believe, 3 months, but that's it. What you're going to need when you retire will be a copy of your birth certificate and a copy of your birth certificate of your co-participant if you're taking Plan D. You're going to have to choose your retirement payment plan. You're going to either take Plan N, Plan C, or Plan D. You have to decide what you want to do with your 1% account or voluntary account, whether you want an annuity, or whether you want a lump sum, whether you want to use it to buy service. You also have to designate whether you want federal taxes to account. If you don't have if you don't make an election, the retirement board automatically will take it out on the basis of married claiming 3. But you can decline not to have federal tax taken out, which obviously will not absolve you of your tax liability. And if you can file quarterly, but most people will have the retirement board figure it out for you, based on the tax papers. Married claiming 1, single, 0, whatever. As far as state taxes, if you're a Connecticut resident, you're going to be liable for Connecticut state income tax. I usually tell my clients, take out 5% of whatever your benefits will be. So if your pension benefit's going to be $4,000 a month, 5% would be $200. You have to give them $1 a month. There's no tax table to figure out the state income tax. You also have to indicate whether you have any additional credit service to purchase. If you haven't purchased it, you should list it on the form. For example, substitute teaching, there'll be a block for substitute teaching, on-state, leave of absence. Put the date in. A good thing to do is if you have a copy of the documentation, send it in, make a copy, and attach it to your application, even though you've already sent it in previously, because that may be in that section of the office, and the person who's processing the retirement application will see that copy, so it's a good idea. The other thing you have to do is all payments have to be done by electronic transfer, EFT. So you have to go to your bank or credit union and have them fill out a section of the form. And your payment will automatically go into your checking or savings account. If you retire July 1st, you will get your first benefit payment at the end of August, the last business day in August, but it will be retroactive. You'll get 2 checks, one for July and one for August. As far as notification, the retirement board will send you a notice when you get your first payment at the end of August. Then you'll get another statement at the end of September, because in August you'll be getting 2 payments. In July, and in September you'll be getting 1. So anytime your benefit changes, they will send you a notice. So you probably won't get another notice until the following July, when you get your first cost of living increase. But anytime there's a change, even if you initiate it, you want to change your withholding taxes, federal or state, you'll get notification. So that pretty much concludes my presentation. There's one more slide.